Today's topic is Life Insurance 101, the types of life insurance. During this lesson, we will learn about the many types of life insurance that is available in the marketplace today, identify the uses and types of life insurance and where they fit, and discuss the pros and cons of each solution. Every life insurance policy is intended to pay a death benefit upon the death of the insured. However, each type of life insurance can provide different options depending on your client's situation. There are two basic types of life insurance available: term and permanent. Term insurance provides protection for a specific period of time. Permanent life insurance can last a lifetime and may provide additional value beyond the long-term death benefit. There are also many types of permanent life insurance, which includes universal life, whole life, and final expense, which we'll go into shortly. In addition, there's also single premium life, which is a fully funded life insurance policy often used for legacy purposes, and survivor or second to die policies, which are often used for estate planning or special needs planning. Term insurance is a basic form of life insurance that offers affordable coverage for a specific period of time, such as 10, 20, or 30 years. It only pays a death benefit when the insured dies during the term period. Because of the basic coverage of term insurance, the premiums are usually the least expensive of all life insurance products. Term insurance does not build cash value, but some term policies may be convertible to permanent coverage, which is a great benefit. There are a lot of uses for term insurance, and is a great solution for parents who are raising a family and may be on a limited budget. Term insurance can be used to pay off debts, such as a mortgage, student loan, and installment debt. Another use of term insurance is to supplement group or permanent coverage to make sure the insured has the proper amount of life insurance in force. Here are the pros and cons of the term life solution. Term insurance is less expensive in the short term, fills a temporary need, provides a tax-free death benefit, and may be convertible to permanent coverage. On the other hand, the insured may outlive their coverage and may not get a death benefit. Renewal premiums can be very expensive if you need to extend the coverage beyond the original term, and term insurance does not build cash value. Permanent life insurance can provide lifelong protection and offers flexibility and other advantages that term insurance doesn't have. The first type of permanent life insurance we'll cover is universal life. Universal life is a flexible form of life insurance that brings together long-term protection and accumulation in one vehicle. One prominent feature of universal life insurance is the opportunity to build cash value within the policy on a tax-favored basis. These are additional dollars that can go towards retirement, college funding, or unplanned emergencies. The amount of cash value growth is dependent on the premiums paid, credit interest, and policy charges. There are three ways to grow cash values within a universal life insurance policy: fixed, indexed, and variable. This visual shows where they each fit in the risk-reward spectrum. With fixed or current assumption universal life, the cash value growth is tied to a fixed interest rate and is determined and guaranteed by the insurance company. This type of UL design has the lowest variability of returns. With an indexed UL, the cash value growth is tied to the performance of a market index, such as the S&P 500. The policy owner shares in the gains of the underlying index while being protected from index declines. IUL has a medium variability of returns. With variable universal life, or VUL, the cash value growth is tied to the performance of underlying variable investment subaccounts to offer greater cash accumulation. Because there's no downside protection, the policy owner rides the highs and the lows of the market, and negative returns can reduce cash accumulation values. The fourth type of universal life insurance is guaranteed universal life, or GUL. These policies provide guaranteed long-term protection when cash values are not a priority. With GUL, the policy owner can typically select the amount of coverage needed, the length of coverage, and the amount of time to pay premiums. GUL can be used to pay for final expenses, wealth transfer strategies, to protect Social Security or pension income, and charitable giving. With GUL, The level premiums are less expensive than whole life, and the protection is not dependent on the cash value. The policy owner gets a long-term tax-free death benefit, and some policies offer a return of premium in future years. On the other hand, GUL is more expensive the term, missed or late premium payments could jeopardize the guarantees, and these policies do not build significant amounts of cash value. The next type of permanent life insurance is whole life. Whole life is a straightforward policy offering a level premium with both a death benefit and cash value component. Whole life offers permanent death benefit protection, level premiums that will never increase, fixed cash value growth, which is less risky, cash value access with loans and withdrawals, and participating companies pay dividends. When a mutual insurance company has a surplus after paying claims and expenses, the board of directors may elect to pay a dividend to participating policy owners. In a technical sense, dividends are return of premium to the policy owner and are not guaranteed. Since they are return of premium, they are not taxable as income unless the dividend exceeds the premiums paid. Once a dividend is declared by the company, the policy owner has several options which can be changed throughout the life of the policy. The policy owner can apply the dividend towards the premium. They can purchase paid-up additions, which increases the amount of the death benefit. They can leave the dividends on deposit to earn interest. They can choose to repay a policy loan if necessary, or they can receive the dividend as cash. Another kind of life insurance is final expense, which is affordable life insurance that helps pay for the final expense and lessens the financial burden when losing a loved one. There are 3 ways to pay the premium on a final expense policy: with a single premium, limited pay, and lifetime pay over the life of the insured. Final expense life insurance typically has 2 levels of underwriting: simplified and guaranteed issue. Simplified underwriting streamlines the approval process, providing faster turnaround time for both you and your client. As the name implies, guaranteed issue means guaranteed approval for your applicants. They cannot be turned down or declined regardless of health, hobbies, or occupation. Many people who apply for guaranteed issue life insurance are not in very good health. And there are 3 death benefit options available depending on the product and the underwriting outcome. They are level, graded, and modified. As a recap, life insurance can help your clients in many ways. And there are many types of life insurance from which to choose. And each option is designed for a specific purpose, meaning there are pros and cons to each solution. Thank you for your time, and thank you for all you do to provide financial security for your clients.